Good morning, everyone, and welcome to December Trade. Today is Thursday, December 1st. Michael Boutros here with you guys. Welcome to the live intraday strategy webinar here on SB Trade Desk. We just got the release of initial jobless claims coming out slightly higher than expected. Continuing claims also slightly higher. Shouldn't be anything too major today. Obviously, tomorrow, guys, we have the more encompassing non-farm payroll report. A quick look at that. Looking at tomorrow's print, we are looking for a print of 180,000. Unemployment widely expected to hold at 4.9%. As always, we'll want to pay close attention to the labor force participation rate as we've continued to see that sort of really affect that headline unemployment percentage number. So expectations for tomorrow. Good to be with you guys here in the room. D will definitely take a look at Euro Pound. It's on the list. So for today, I'm looking at the DXY, obviously, real quick. The Aussie crosses have still been my favorite play all week, guys. Aussie Dollar, Aussie CAD, Euro Aussie. We'll touch base on Euro Pound. Sterling Dollar and Sterling Kiwi also on the menu. Kiwi Dollar, Kiwi CAD we'll touch on. And to get things started, we'll touch base real quick on crude on the back of yesterday's OPEC meeting. I know Conwell is looking at that as well. So we'll start off by talking about the oil trade. I also want to take a quick look. Let me jot that down. The Nikkei 225 coming into an area of interesting resistance. And that's what's on the list for today. If you guys have any other questions, specific trade setups you want to review, feel free to throw them on the message board at any point throughout the course of this session. A quick reminder, again, heading into the start of December trade, the FOMC interest rate decision, where we're expecting essentially the Fed to move on interest rates, is scheduled for the 14th. So that's a little over 2 weeks away at this point. With interest rate expectations, look at this, guys, basically factoring in 100% probability of a hike in December. Okay, so expectations for that move are pretty much solid at this point, I think we can say. The only issue here is the slope or the gradient moving forward. How many hikes can we expect heading into 2017? We came into 2016 expecting 4. We haven't gotten any yet. Obviously, we'll get one this month, but it's really the expectations moving forward. Eileen says, and 100% throughout 2016? No, so throughout 2017, Eileen, what you want to look is here. Right now, we're looking at 25 to a quarter to 50. That's right here, right? So basically, when we look to further months, you want to keep your eye on this column here. We're going to move. This is where we'll be at the end of this month. So half to 75, 75 to 1. This is the expectations you want to look at moving forward. So for 2017, you don't really get a material expectations for higher interest rates for the entire year right now. And that was something I was speaking to a couple of different guys here in New York about this same exact thing, Eileen. I was looking at the 2017 expectation, you know, when we'll move in the next 25 basis points. There's nothing above 50 for the entire year. Now, that's not to say that we're not going to get it, guys. And expectations, certainly if we look at the dot plot from the Fed, there are high expectations that we'll see 2 to 3 hikes maybe next year, right? But as it stands, what this is saying, Fed Fund Futures, is that the markets are not pricing in or have not yet priced in subsequent interest rate hikes, which is why, to take it back to the statement I made earlier in the session, which is why the main thing here, guys, is what's the projections look like moving forward. Forget December. That's in the hat already, right? What do we look like moving forward? So as it stands right now, markets aren't too convinced we're going to get too much action yet in 2017. We'll have to see how this shapes up. Remember, this quarterly or this interest rate decision is a quarterly one. So we're going to get not only the updated statement, but also the updated projections as they pertain to employment, growth, inflation, and the subsequent presser with Janet Yellen. So definitely a major print coming up over the next 2 weeks here with the FOMC interest rate decision. Hey, Horace says, good morning to all. Great to see you. Does this reflect the dot plot? So this doesn't necessarily reflect the dot plot. Here's, Eileen, here's good question. The dot plot is basically what the Fed is giving us as far as expectations of what they see, where they see markets, or the interest rate, rather, moving forward, right? Here, each yellow dot here represents one of the committee members on where they see or where they expect interest rates moving forward. Okay? So for 2017, you can see that the median is all right here, just above 1.25%. Okay, there's an extreme of 2.25 of a member who sees it as high as that. There's another extreme of 0.75, two members who see no change moving forward, with really the majority around that 1.25. So that would give us another 2 hikes moving into next year. That's what the Fed is expecting. Fed fund futures aren't really pricing that in yet. So there is a slight divergence between what the Fed is relaying and what the markets are actually anticipating. It's often the case, and that's what really prompts price action, is that unequal, uneven distribution. Eileen, does that make sense? Euro dollar 2, let me write that down. We'll be on the list. Sure, we'll take a look at euro. Eileen says, yes, makes sense. Right on. All right. Okay, and Graham says, so in a year of moves that caught markets out, such as Brexit, Euro, Swiss, etc., what happens if the dollar rate frozen? Graham, give me a little bit more explanation on that. I'm not sure what your question's asking. Do you mean if they don't move on interest rates? I'm not sure what you mean by frozen this month. If they hold interest rates this month? Yes, if they hold this month. Okay. First of all, Graham, I can tell you just from a personal standpoint, doing this for years, I really doubt that they're going to hold. Okay. Markets are at all-time highs. You're starting to see inflation start to creep back into the fold here, and the Fed has been under extreme pressure to really start to normalize policy, specifically heading into the new Trump administration, something that he's continued to relay, right? So I really think that's an outside scenario. But let's just play it for devil's advocate, Graham. Let's say they do hold on rates, right? Well, the initial knee-jerk reaction is likely to be a pretty nasty spill in the dollar, but I don't think it would be anything that would be lasting. Because if they do hold, Graham, that puts all the pressure. Every subsequent meeting is pretty much going to be a shoo-in. Everyone's going to be expecting that hike. So I would expect to see a knee-jerk reaction sell-off in the dollar that could give lift certainly to the pound specifically, but more so maybe pause this Aussie decline, maybe give a little bit upward of a rally in the dollar-yen. But largely speaking, Graham, it's very, very difficult scenario to envision. Even if you look at yields on treasuries and bonds, they've just been surging, especially on the long side of the curve. So your 30-year is just, it continues to play higher. So these are things that are welcome developments from the Fed. They've been wanting yields to move higher. Certainly as yields start to move higher, if they do move with such an accelerated rate, it will be a concern because then it turns back as a negative feedback for the U.S. economy as it becomes much more expensive to service our debt. But as it stands right now, no, I think it's pretty much, I think it's pretty much there. It's pretty rock solid at 100%. Graham says, thanks for playing devil's advocate. Hey, more than welcome, man. I'm always open to play the other side of the trade and kind of just think out what the scenario would be, right? All right, so let's jump right into the price action here. So, Conwell, I'll go into crude in just a moment. Really quick, because we got that release, I just want to touch base on the dollar index. I highlighted this chart yesterday. Levels remain unchanged, guys. We cited a downside bias well below the high day close at 101.69. That's still kind of what I'm thinking right now. You can see that yesterday we did probe and go through a rally, try to break through the high day close for the year, which comes in at that 70 level, 69 to be precise. Failure, closed below it. I still think if this is going to be a correction, you'd start to look lower, you'd continue to look lower below 101.70. Near-term support, and a level of which I'd be interested in, is here. Okay, that's this region right here. You're basically looking at the December highs from last year. You're looking at the 100% extension, so 2 equal legs down if this is just a simple correction off the high, and that would give you 142 into 100 spot 51 as a near-term support target. Also notice that a sliding parallel, the same slope we've been following, extending off the highs from July, actually comes in right there over the next couple of days as well. If we topside break here on NFPs tomorrow, look for near-term resistance near that median line that we just missed on this last rally. By the way, I was just messing around with this chart yesterday, and one of the reasons I posted it is because I noticed this little pivot right here. So all of these slopes are derived off of basic trendline support off the yearly lows. Okay, this is a confirmed trend line. You have 1 touch, 2 touch, 3 touch, 4 touch, just missed. So if we take this line and extrapolate it, here's a parallel that played well. Here's another parallel that played well. Here's another parallel that played extremely well. Take that same slope, extend it to that gap close that we made on that Friday on the 19th of February. Look at price action. Rebound, support, support, break, resistance. And that slope comes in just higher. So I'm starting to get a little bit more confidence on some clarity here in the dollar index. I still think you're at risk in your term sub 1 to 169. Key support, 100 spot 42/51. All right. Also note the momentum signature has also broken below 70. And not only did we break below 70 after that high that we made for the month of November, we also came back and checked 70 as resistance and pulling off here. So certainly from the momentum standpoint, it does also look like you're seeing a little bit more of a conviction exhaustion trade here. On its face value, I just want to note that this has made a simple weekly opening range. Here's the 240-minute chart. Here's your weekly open. You stretch into a low. You stretch into a high on Monday. You kind of tried to probe through that high yesterday and failed, but largely speaking, your weekly opening range is still in play. So if we get a downside break below the lows that we made at 100 spot 85 or so, that would be just an objective break looking for that stretch down into that key support confluence near term. Below that, the 100 mark, okay, is the high day close from last year, 2015 HDC, and that converges on this clean median line, a little bit even cleaner than that parallel there. So that takes you down to this region. All right, any questions on the dollar index? By the way, how much credence does the market give to the Bloomberg dollar index? Don't see its charts around much. Had to really search for it after seeing Bloomberg article referencing it. But would it seem to make better sense? Eileen, I want to say no. I don't want to be blatant about it. But I don't. Look, they're all using derivations of various pairs in the performance. So no, I haven't seen the Bloomberg dollar index also quoted too often. You know, when you're looking at these indices, guys, the most important thing for me personally, I'm just going to tell you from my side, Eileen, is I want the index that's being viewed by the most amount of market participants. I want the index that has the most amount of volume and participation in it, because that means price action is more indicative of what the broader mass market psychology is saying. If we take an index that's not really as widely traded, you know, you're taking an opinion on a stance of a much smaller pool of market participants, whereas the ICE dollar index is pretty much the standard across the world. You know, people on the Nikkei desk will look at the ICE dollar index, the Dixie. People in the UK, I know, you know, they're always looking at the Dixie as well. So you want to look at what the markets on whole are paying more closer attention. Does that make sense? Wow. Yes, that makes better sense. Cheers, Eileen. Good question. Good question. Same thing with the Dow Jones FXCM dollar index. Eileen, remember, we always follow that. I've been following that for years. It was a product of FXCM. Obviously, now that we're with IG, we don't really, or that Daily FX is with IG, they don't really stress it too much. But while it's a very nice indicator for dollar price action, because it's a little bit cleaner with just the 4 major currencies most widely traded, you're not going to see that this is as such a widely traded asset as the DXY, which is sort of why we, over the last couple of months, you might have noticed, we sort of come back a little bit more to rely heavily on the DXY now that we're at all-time highs. You know, the Dow Jones FXCM dollar index hasn't really seen these highs previous in price action to its inception. So, sorry I went on a tangent there, but good question, Eileen. Okay. So, if there are no other questions on the dollar index, going once, going twice, keep your eye on that 100 spot 42, spot 51 near-term support. Let's go over crude here for Conwall. So, what a surprise, right? OPEC finally does something. All this indecision, all this expectation that they might actually cut production. They did agree for a cut production of 1.3 billion barrels yesterday, which is not actually as high as the market expected, but the consensus move was enough to really charge a massive rally. Remember, guys, just a reduction in production means lesser supply in the market. Basic, you know, supply and demand drives prices higher. So where do we go from here, Mike? This is just an obvious and you know, blatant breakout, right? So look, this is what I want to say. Let me start with the daily chart. This has been a pretty messy chart as of late, but a couple things I want to note. First of all, the rally that we made here is a validation or invalidation of the monthly range, right? Here's the highs. We just broke higher today, pushing higher. That gives you an upside bias. Initial targets are being hit right now. Okay, this is the reversal day close from October 20th. And near term may offer some resistance, more critical resistance, and the level of which I'd be expecting a little bit more of a key hold near term is up here. All right, Conwell, 51.41 into 51.64. You're looking at the high day close for the year. That was on October 19th. You're looking at the June swing high. That's 51.64. You're looking at the 1618 extension of that first leg up from the rally off last month's low, and that's 51.60. So this whole region right here is pretty major for crude. Okay, pretty major. And certainly from a longer term approach, that's kind of the levels that you want to keep in mind. Here's what it looks like on the intraday. And I wanted to update this chart while we're here together. Obviously, there's some fibs on here we need to redo. So just to put things in perspective, that level that we highlighted as support a couple of days ago, Conwell, 44.85, it literally tagged it to the pip. I think it dipped into the 79 region before rebounding. But that was a basic 618 retracement of the entire rally. This was an exact 100% extension, 2 equal legs up. So a really nice level of resistance there that we pulled off of. Here's the breakthrough. Okay, so this retracement now is null and void. Let's get rid of that. We have a new high in place. This trend line is null and void. We've invalidated it and broke. This formation, and go ahead and get rid of it. We played with it for quite some time. This is from the early October highs, but now that we've cleared that, we'll go ahead and get rid of that. And what I wanted to highlight is this formation. Okay. So this pitchfork off the highs that we made from June and the highs from October, okay, really nice reactions right along the median line. Okay, resistance, 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 support, breakthrough, resistance, little messy, support. Okay, here's the upper parallel. So if this break is legit, I'm still looking for that rally towards that 51.65, 51.40, real critical area of resistance. And I think, guys, on the back of a move like this, you start to look for maybe a slow drift higher, maybe some consolidation within the range that we made over the last 4 weeks before this thing explodes. I know Jamie spoke with you guys yesterday about this in the midweek strategy webinar. You know, seasonalities don't really turn too supportive on this just yet until basically the new year. So I don't want to get too excited on it. The fact that the dollar is pulling back off resistance should fuel this and keep it rather supported. So Conwell, I wouldn't necessarily get excited about any type of short exposure yet. But certainly on this rally, I do think that you risk a little bit more of a drift higher towards that 51.40, 51.64 region. Nothing I'm personally interested on an intraday basis from this level. Okay, remember the invalidation was the monthly open. Once we cleared that, you're basically looking higher here in crude. Near-term support, I'd be looking at 40.78, 40.90, same level of resistance that we hit last week, same level now converges on the former lower median line parallel right here. Key resistance, this region here. A broader 100% extension from the ascent off the lows actually takes you all the way up into 52.50. I don't think you see that, but just as a what-if scenario, if things all go haywire and the dollar really takes a dump, those are the levels I'd be looking here on crude. Conwell, questions on crude before I move on? Let me know if that makes sense. Yeah, definitely that production cut was a little bit more of an offbeat that the market caught offhand. A lot of shorts got cleared out on this region, guys. A lot of shorts. A lot of people got caught out on the wrong hand of this crude trade, as you can tell by what price action is doing. So for today, levels are interim resistance, Conwell, right here at 50.63. A topside move beyond here, I'd be looking for 51.40 into 51.65 as near-term resistance. Support 48.90. And that is crude. So DXY number 1, crude was number 2. Let me know if you're with me, Conwell. We good on that? Okay. He says, thanks a lot. You're more than welcome, Conwell. It might be worth it just to take a little bit more of a lower approach. Remember, guys, what I wrote in the report yesterday, it's still the first day of the trading month, just as risky as the last day of the trading month. So you just want to make sure if we're taking on any positions that we are, any intraday positions, okay, more shorter term, that we're taking on less leverage. Okay, I've been trading on half leverage basically since Tuesday, which I'm kind of not too happy about because the Aussie positions were actually played out really well. I wish I was a little bit more leveraged on those, but caution pays in this type of market environment, and especially heading into the last final month of the year with non-farm payrolls on Friday, it pays just to be a little bit more cautious. Okay, that is crude. Let's jump into yesterday's updates and get into the nitty-gritty. So, excuse me, as far as the Aussie is concerned, here's what the Aussie looked like last night. We've been following this one since the Sunday Open. Obviously, we were looking for a rally into 75, just shy of that. We got that. The reversal, if you guys remember on Tuesday's webinar, I was actually short. I'd shaved off 3/4 of the position, but then I left a quarter open trying to get the break below this weekly opening range low. It didn't, and it rallied and took me out again at break even. As I noted, I jumped right back in on Wednesday night there. So we were looking for a move into 74.30. I closed the rest of the position here at 73.85. So we are getting a near-term rebound. There was another opportunity to get short. I didn't take it. Obviously, it was an overnight. But on the rally to 74.20 again, yet another opportunity to get back on the short side here. So broadly speaking, let's just look real quick. Here's what the daily chart looks like. You had a nice reversal. This is 2 equal legs up, textbook, 100% extension. You had the median line off the high, basic 38.2 retracement for the monthly range. Okay? Momentum turning ahead of 50. It could still make another leg higher, but I like it lower below this region. Okay? Broader bearish invalidation level still has to stay up at 76, but largely speaking, I like Aussie dollar lower. A break of the weekly lows here, you're still looking for that median line there. More importantly, 73.30 is a big level. It's a 50% retracement of the entire yearly range. It's also the close low for last month. Not the low day close, but the actual concerted close low. And a quick way to view that is just to bring it into a line chart. Pretty nice. Pretty nice. Okay, so looking for opportunities, looking for exhaustion on some rebounds here to get back in the short position has been my favorite setup so far this week. Definitely they've been playing out really well. Again, here's what the 4-hour chart looks like. Take another zoom into the 2-hour. You can see how many times this thing ran to 75 and how many times we took a short on every single one of these entries, if you remember. Even on the Monday webinar in Daily FX, again, that one took half off. I got stopped out at break even on the rest of that half. Again, here was the second attempt, got stopped out at break even on the quarter, and then the last one actually played out pretty well. And this, guys, is something I just wanted to address today. This is the benefit, the strength of our strategy as far as a near-term approach, in that, yeah, I could have sat in this Aussie short all week long waiting for the turn, but instead, because we were nimble, we were able to play this on a much more intraday basis, you got to play this range, 3 times, which means you've maximized a 100 pip range on a nice scalp formation on 3 different attempts. So when you find these really well-defined regions of confluence, structural resistance or support, Fibonacci resistance or support, major highs or lows, these are regions of which you want to be a little bit more aggressive against playing. Long story short, looking for rebounds to get short here. Again, I like to stay bearish below the the weekly open. Weekly open comes in at 74.41. The weekly opening range low comes in at 74.33. So this region right here is what I'm looking for near-term resistance. Downside break, subsequent targets at 73.31. Like I said, that might be a pretty big region. And then the yearly open coincides on a basic 786 retracement from the advance off the May lows. That's 72.80 into 72.82. Here's what Aussie looks like on the 5-minute. I've been scoping out, seeing if we can get some sort of trigger here near term. I want to see this a little bit closer to resistance before I start to take a stab at any type of counter trend move here on this initial bounce. But even on this bounce, guys, you saw some divergence into a trigger break. I thought I had that drawn on here earlier, but let me just draw it right back on. Price action making a series of lower lows, lower lows, lower lows, higher low, trigger break, come back, zoom, retest that support, bounce off. So this is a counter trend trade. I'm not really looking to play the rebound. More so, I'd be looking for this rebound to offer some better short exposure. Again, 74.33, 74.40 being the favorite area of resistance. No change to any of those levels. Any questions on Aussie dollar? Do keep in mind that later tonight you do have Aussie retail sales coming out. Here's what that release is supposed to look like. You're looking for a print of about 0.3%. That's down from a previous read of 0.6. It's a month-on-month reader for October. Comes out at 19:30 here in New York. Definitely will be a candidate for tomorrow's non-farm payroll print. I definitely will be interested in watching what Aussie price action does on a dollar rally. If it does come out a strong number, look for that yearly open basically. But on a spike, if the dollar pulls back, I'd be looking to fade that move. As long as Aussie holds sub 74.40. Questions, going once, going twice, that's Aussie dollar. Number 3, again, retail sales later tonight, don't forget. Number 4, Aussie CAD was another one that we covered yesterday as well. We've been tracking this one for a couple weeks. Here's what Aussie CAD looked like last night. If you guys remember Sunday's update, we were talking about 10065 as being a near-term area of resistance. We started the week there looking for short triggers, looking for specifically exhaustion. Okay, we were looking for an exhaustion into that 106.63, 106.65 region. Well, you basically got it. Okay, here's what it looks like right now. And here's what it looked like last night. So you saw that spike into that region, quickly fail and pull back. The subsequent highs that we made for the week heading into Tuesday and Wednesday really respected that yearly open 38.2 confluence like a ceiling, like a hard ceiling, very, very clean resistance. So right off the bat, heading into yesterday, you had a very clean weekly opening range. You're just looking for a break to validate your directional bias. Well, there it was. Near-term targets got taken out right here at 99.57, 99.25. And like I said yesterday in the piece, you want to stay bearish sub 99.57, looking for that stretch down to 98.60 and subsequent targets down into the lower parallel, extending off this low. Boom, 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 boom. 98.30s or so right now. Bear with me one moment. I do want to check out what this extension looks like. Oops. Interesting. Okay, so this swing low that we made right here in August actually comes in dead in line with a 1618 extension from the decline off the highs that we made. Boom, boom, boom. 1618 coincides right there. 97.34, 97.63. Nice targets on a downside break of this formation. Might be worth checking out. Levels look pretty clean. No change to yesterday's update. Look lower, sub 99.57. Any questions on Aussie CAD before we move on? Interestingly enough, Kiwi CAD looks pretty good too. We'll talk about that. But I want to stick with the Aussie crosses here before we finish. Any questions on Aussie CAD? Okay, Euro Aussie looks like this, number 5. Also on last night's update, here's what Euro Aus looks like. So since the beginning of the week here, again, back on the 27th, we were talking about Euro Aus coming off of confluence support, right? Near-term resistance targets were at 143.03, 143.47, then 144.14 into the monthly opens, a big region of resistance. We failed just ahead of that yesterday. Here's what a Euro Aussie looks like now. Propagated by further Euro strength and continued Aussie weakness. This is one of the reasons I liked this trade yesterday. I do want to come in today right now, if anyone's holding positions on this, with a very quick caution of this very obvious divergence that you've seen with price action making a higher high into confluence resistance as the oscillator makes a lower high. Again, as I always note, these divergent signals above 70 aren't very strong typically. Below 30 aren't very strong typically. Nonetheless, it's there, and you have a very clear-cut support trigger ready to go. Okay, this is on a 2-hour chart, so you give a little more credence if the market does actually close the candle below that. But the point being, the immediate focus is the immediate upside bias is at risk here near term heading into the U.S. Open. I'd be looking for that pullback somewhere near 43 would be an area. Again, I'd look for some support. Bullish invalidation is at the weekly open at 42.48, 42.50. Okay, so looking for this pullback to give me some more long entries at one of these targets. We'll look for some triggers. And if we do get this topside break, again, this is the invalidation zone for the broader downtrend. If we finally clear the monthly open from last month, that 786 retracement, that would also necessitate a break of this formation, and that would really give us a little bit more of a go-ahead on the topside approach here for Euro Aus. Hey, Conwall, yep, I won't forget silver and gold. Actually, I didn't have silver on there, but let me write that down. Gold for sure. Continued move lower in gold. It continues to break that support target. Everything is unchanged on that, but we'll go over it in a moment. Any questions on Euro Aus before we move on? That's number 5. Okay, who was it for Euro Pound? Is that D? Was that D? Yes, D, it was you. Euro Pound. Here's the Euro Pound. So that was yesterday's update. The previous update had a Euro Pound setup in it, if I'm not mistaken. Yep. So I haven't personally gotten involved in this, D, but you're right. It does. The break does look real. So we started off the week talking about this major critical support zone at 84.79 into 84.91. You're basically looking at a basic 764 retracement. You're looking at 1618 extension, structural support, longer term, near term slope support from the decline. It's all lined up right here. And we kind of opened up the week, setting the weekly opening range just above that key support. So it does look like today's move is in fact breaking to the downside, but I don't want to necessarily prescribe that to Euro weakness as much as pound strength. We'll look at pound dollar later as well. Finally getting the topside move. If you guys remember, last week we were bullish pound. It kind of teetered out on the long side and started to pull off again, which was kind of concerning. We're finally getting that move starting to follow through now. Obviously, now that I'm not paying attention, right? But we'll go over that in a moment. But here's pound strength, really prompting that break. And the validation, D, was not only the break below 84.91/79, but it was the zoom in retest, a very tight zoom in retest. Break of support, check as resistance for a couple of hours, and then move off. That validates the break. And as we always say in these webinars, guys, this is how you want to play the turn, or a break of resistance, or a break of support. So you wait for the breakthrough, zoom, retest, former support, or former resistance as support, look for the breakout. Here's a break of support. You look for former support to act as resistance. And here's the breakdown. Downside target, 83.49. I want to know what level to target if it breaks 83.50. So if it breaks 83.50, here's what I'm looking at. All right. First of all, that whole region I want to open up to D, because just below that, you see this 50 line here for the current slope? That's this. So that could like dribble down just into like 83.30. I'd hate to see you look for the move into the 200-day moving average and then get, faked out on that stab into the median line, then a rebound off it. So watch this whole region here. If you're holding shorts, I'd be looking to take some off the table. At least bring your stops down to 84.90 if it's not there already. The next downside move, you're looking at the lower parallel, but ahead of that is the 200-day moving average and former trendline resistance. Show you the daily chart. 1, 2, nice pivot this here, break, act as support. That converges on the 200-day moving average. So you're looking at like 82.70 into 82.85. Does that make sense, Steve? 83.50, you have that median line just lower. Also look to the left. It's the low that you made for September. That concerted low is actually 83.36. So I would watch that region, 83.30 into 83.50. You might catch a little bit of a rebound, but this is the more critical region, I think, near term that you want to give more attention to. But nice break of support there in Euro Pound. D says, yes, thanks. Hey, D, you're more than welcome. Well done on that. Looks pretty good. Hello, could you get in, or could I get you to go over the dollar CAD? Thank you, Kelly. Absolutely. Welcome back. First of all, good to see you back in the room here, Kelly, but we'll definitely take a look at dollar CAD. Let me jot that down. Okay, so Euro Pound, that was number 6. Let me just finish with the sterling crosses here, Kelly, and then we'll jump in. So any questions on Euro Pound? Again, prescribing this mostly to pound strength. Looking at, oh, is that 10-4? Oh, 10-4 like walkie-talkie 10-4. Gotcha, Kelly. I was like, what is that? Pound dollar. Here's what pound dollar looks like. So with the pound, I mean, I'm kind of ticked because I missed it, but, it's as clean as an opening range break as you're going to get. Here's your weekly open. Okay, you set a weekly opening range high on Monday. You set a weekly opening range low on Tuesday. You test the highs again on Wednesday. You try to make a move on the lows and fail. Break, shifts the focus higher. Targets all are taken out basically into 126.83. Bigger resistance is up here. 50% retracement. Structural trendline resistance and median line resistance takes you up into 27.60 into 27.67 on this stretch here for Euro Dollar. Here's what the daily looks like, just to put things in perspective. That's this region here. So you can tell it's a little bit delayed. Our target was up here at 26 last week. Obviously, it kind of went lateral, started to melt away towards the end of the week. A couple of days late on it, but here we are taking out that high. Next topside objective, like I said, basically looking at 28, just ahead of it, you have the 100-day moving average, structural resistance, former channel support, which has been a decent price in purple here. Decent pivot, support, that converges there as well. So I'm curbing my topside appetite here for sterling over the next 24 hours. Okay, heading into NFPs, watch that 28 handle. Pretty big. Pretty big. At this point, we don't really need this retracement. Just took out that high. Clean that up. Oh, stop traffic. Look where that median line. Just take basic channel and extend it off the high. Now this is just you're extrapolating, right? You don't know that this is going to be any type of meaningful resistance level, but a parallel off the low, taken to the high, converges on a region we're already watching. So prudence, just to keep an eye on that. 28 handle is the upside in sterling. A break there would really validate this thing for a more concrete turnaround. And just for argument's sake, or just for a little drill here, I also do want to see, guys, what this extension looks like. Bear with me one moment. Let's clean this scalp up as well. Don't need this, don't need this, don't need this. Okay, a subsequent topside target takes in 28.90. I'm going to leave it there, but right now, this is the focus. Okay, just ahead of 28. Any questions on pound dollar before we move off? Non-farm payrolls on tap tomorrow. Keep that in mind. Pound key is my favorite one as far as the pound crosses are concerned. I wouldn't say, maybe not my favorite one. I do like euro pound a lot, but this is, I think, very clear in what you're seeing as far as the breakout's concerned. So for pound kiwi, here's what we looked like earlier in the week. Okay, so what we highlighted was, look, we're in this sort of descending median line formation. Too early to tell, but we're looking for support at 74.85. You got this. We talked about it earlier. You did get a bounce right off that level yesterday, which took you just shy of target, which was the actual weekly open, before making another break to the downside and holding that 38.2 retracement. That's this level right here. So quick drop into that region. I thought I saw divergence there. Yes, I did. Okay, so here's divergence. Price action making a lower low in price. The oscillator making a higher low in price. Again, a trigger break right here. Shifted the focus to the upside near term. Take the trigger from the high in price. Oops. Divergence into a trigger break gave you the exact point of which the breakout originated. Again, there's the monthly or the weekly open, 77.07. This was the bearish invalidation level at the high day close, 77.74. We're now cleared that to the top side. Looks like this thing's got a long way to go. The implications of this break, guys, are massive. My humble opinion. You know, this is a very, very clean formation. If we take just basic parallel resistance off the highs that we made for 2015 here in September, take that to the original low that we made here, what was that, February? Okay, caught the highs, resistance, support, same slope off the lows that we made in July, caught the swing low that we made on election day, or no, this was October, excuse me, on that October 7th drop off. And then here's the rebound. We sat just below resistance, and this was the premise of what we were talking about on Sunday. Look, big resistance, high day close, 100-day moving average, slope resistance, it's all stacked up right here. Not to mention that 77.08 is actually the 2013 low in price. So it's a big region, and we just cleared it. If we cleared it on a closed basis, which I think we'll do today, I would validate this as, you know, a basic breakout to the upside. Look at momentum now above 60. Or we'll have to see what today looks like on the close, but it's looking like it's going to make a above 60 break, a little bit more conviction than we've seen. Long story short, keeps the focus higher while above 77 at this point. Wider range ATR, not for the lighthearted, guys. Sterling Key, you know, has that volatility where you can get a little bit more of a meaty type of positioning on it. Questions on pound key? Let's see if we can't figure out some near-term targets. Let me clean this up for you. Don't need that anymore. This formation is null and void. That retracement's done. Don't really like to work with these real steep pitchforks, so I'm not going to really stress this, guys. I just wanted to kind of take a look and see what we're looking at here, if there's anything that kind of stands out at you. That might not be a bad setup there. Actually, I like these breakout targets, 80, 83, 81, 80, 81, 53 on a topside stretch. You want to stay constructive well above the weekly open, which is just right around that median line now, right here. Not bad. And last but not least, sorry, one sec, guys. I just want to see what this channel. Okay, nothing there. Okay, any questions on pound Kiwi? Stay constructive above 177. Essentially the weekly open stretches down a little bit lower, sub the handle, 76.50 or so. Wider range ATR, so watch out. Look for near-term resistance. There might be some slope resistance right here. So if you're holding long exposure, this is where you might want to take a little bit off the table, bring your stops to break even. But basically, you're looking to see if we can see a continued topside move targeting 180, 83. More importantly, that 618 retracement from the decline off the highs from July takes into 81.50. Going once, going twice. That is pound Kiwi. Number 7, it's number 8. Nice breakout there. We covered crude, Kiwi Dollar, Kiwi CAD, and then we'll jump into some more of the other questions that you guys had. So real quick, here's what Kiwi Dollar looks like. And here's what we looked like earlier in the week. Was it here? Yes. Boom. So, started off the week talking about the rebound we saw last week at 65.51 into 69.51 into 69.70. Really nice region. You had the swing lows here from back in June. You had the close lows from back in July. You had a 100% extension, 2 equal legs down on the daily chart, and slope support all converging right there. So on this rebound, we were looking to stay bearish below the monthly open slash a 38.2 retracement right here. And that basically took you as high as like 71.50. Well, it kind of ran through it into 71.67, but it quickly pulled back. And in fact, if you take a look at this on a daily chart, you can see that we couldn't even make a close near that region. In fact, the day that we did it yesterday, not only did we surge through it, but we closed well lower on the session. Nice big old reversal candle off resistance, keeps the focus lower. A perfect, another example, it's a good day for examples, I guess, of a zoom and a retest. Basic trendline support, 1, 2, turn ahead, break. If this is a valid break, you look for the zoom, retest of former support as resistance. Just so happened that you had the confluence there of not only that former support line, but the 50 line for the current operative slope and the monthly open. So inherently into 71.50, I'm looking for short exposure. Here's what the scalp looked like. Again, you saw a little quick of a blow through there, but momentum. Was it an hourly trigger? I don't know where that line came from, but I think it's supposed to be like this. Okay, really clear divergence into a trigger break. Another time where we want to use these signals. If you guys have noticed, Eileen, I know you've been with us for a while. I know you've noticed that I don't want to rely, I haven't been really stressing the triggers lately. And that's because in this type of a market environment with everything that's going on, it's been very difficult to really use this as your singular entry sort of trigger. But when it's there, certainly adds conviction. And specifically when you're testing a key resistance region where you don't know if it's breaking out, you don't know if it's really giving you the move, or you want to fade, this was a perfect example. Resistance or momentum couldn't clear the previous highs, so you got some divergence. Remember, even in momentum, this is a quick note that a lot of people don't tend to think about. In momentum, guys, when you're looking at the RSI, even if RSI makes equal highs, but price action makes a higher high, that's still divergence. The definition of divergence is that you're looking for the oscillator to not validate an extreme in price. So if price action makes a new high and the oscillator doesn't, that's divergence, even if it's equal highs in the oscillator. So these are things that you want to pay attention to, and this was another example of, classic exhaustion, classic failure at resistance to the downside. We've made it back through, the initial weekly opening range. I'd be looking for targets down at the monthly open, the weekly open, 70.44. A nice pivot there at 70.35. We wouldn't really pay attention to it, but it's also the weekly opening range low. So that's what would validate a move on target. Again, 69.55, 69.70. Broadly speaking, this is very clean. Even just the median lines here within the confines of the decline off the highs from September. Very, very basic trendline resistance. Really nice pivot. Support, support, resistance, breakthrough, resistance. False break. Support line extended off the lows from October 12th. Support, support. Now also converges on this key region. All right. Questions on Kiwi. It's like commodity week here. Aussie and Kiwi have still continued to be my favorite trades all week long. Eileen says, glad for the extra explanation on the RSI in these days. Yes, I have really noticed the unreliability of using those triggers alone. Yeah, for me, Eileen, it's best to know when these triggers are going to be served best. And in these conditions where we've been getting a lot of back and forth, a lot of moves that kind of start to fade out and then just fall apart, event risk-driven trades, I just like to use it as an added indicator. I won't stress it, but when I'm looking, oh, price is at resistance, oh, I'm bearish, oh, I want to get short, oh, hold on, there's some divergence to a trigger break. That ends up being when I actually use it as an operative sort of go for. Make sense? All right. So that is Kiwi Dollar. Again, curb your appetite. Starting off the new month, non-farm payrolls on tap tomorrow. Could get another run at 71.36, but I would still be looking for some possible short entries on Kiwi Dollar. That was number 9. Number 10, Kiwi CAD. Oh, we are running low on time, guys, so I'm going to kind of just run through these real quick. Kiwi CAD is another setup that we highlighted earlier in the week. The basic premise of this trade on Kiwi CAD... The basic premise of this trade to start the week was that we came off, again, major key support last week. It's very, very similar to the Kiwi Dollar setup that we talked about. Here we were looking at the yearly open, 94.33. A basic 38.2 took you into 94.22. And that's basically this region right here. You came into it last week. You set up the weekly opening range and never made a damn move. Okay, you had support resistance all the way into the close. On Friday, you popped right through, but you didn't really close well high above it. You closed right at the opening range highs for the week. So to start off the week on this spike, we said, look for this drop. As long as we stay above 94.33, you're looking for a stretch higher. Now, the stretch higher finally cleared the weekly opening range yesterday, but fizzled out right at 38.2 retracement. So if you were involved in this, the reversal back through the weekly opening range highs basically took out that signal, and here we are testing once again key support. So that initial upside bias we had to start off the week basically is given out with this break here below 94.60. If we do make a move below the yearly open here, which I think you will, continue to follow these slope lines, but you're basically looking for a move into the February high at 93.80. Subsequent downside targets, look for the October lows. I wouldn't really stress it near 93, but 92.67 would be a basic 50% retracement of the entire rally off the lows that we made in April. Okay, so pretty clean formation. Pretty clean. Huh. Look at that. Little messy, but resistance or support, failure ahead, resistance. Gives us further validation of trying to continue to use this slope here. So watch that slope line here, guys. It comes in around 94. So first things first, 94.33 into 94.43. Yearly open 38.2. 94 handle might give you some trouble. Wouldn't stress this high anymore for the February trade. I'd be looking straight on a break below this towards that 93 figure. All right. Mike, would you ever use divergence to choose when to take some off the position? Yeah, 100%, Trevor. Well, I shouldn't throw it out like that. Yes, Trevor. This is what I would say. If I'm in a scalp, or I hate using that word, if I'm in a position, intraday position, and the market's approaching resistance, and I see divergence into that resistance, yeah, it might not necessarily, Trevor, shake me out of the trade completely, but for sure I'll be toning down the position. So I'll be looking to take something off, bring my stops up, because we're obviously getting a a divergence signal against the trade that we're in. Would it prompt me to bail on a trade completely? Very rarely. When is it effective, Trevor? Is when price is at resistance and I'm seeing divergence. Divergence in and of itself wouldn't take me out by itself, Trevor. But if we're seeing divergence in momentum and price is approaching resistance, yeah, that to me becomes a concern. And I say this because, again, divergence from a timing standpoint doesn't give you anything, right? You can see something marking divergence for 5, 10, 15, 20, hour, 2 hours, 4 hours. You don't know if it's going to spike up another 30 pips first before turning around. And I don't want to cut myself short because I'm foreseeing something that may never actually happen. So I'm always looking at what price is doing. That's the biggest, most single critical factor. Price is coming into resistance. Automatically, I start to look for signals of waning momentum. That's when it comes into play. Okay, and I can look on those signals. Usually, Trevor, if I'm in a position, I see divergence. The only divergence I'll take into account is, maybe a 5-minute, 15-minute, 30-minute max. And again, it only matters when price is approaching some sort of target because, that divergence signal can just continue to sit there for a while. I don't want to just bail on the trade for no reason. Eileen says, what time frames for RSI these days seem to make most sense to give attention? More meaning to RSI. So for real near term, yeah, Eileen, you got it, right? So for real near term, I'm still pretty dedicated to the 5-minute and 15-minute charts and the 30-minute charts as far as looking for or being able to effectively use divergence. I've been very nimble these days, as I always tell you guys heading into the close of the month. So for these types of positions, the closer time frames are going to give you the signals way ahead of the longer. And don't forget, guys, on any oscillator, nothing matters until the candle closes. So if you're always wondering, how can I rely on this signal? Just know, if I'm looking at a 120-minute chart, got to wait for those 2 hours to close before this means anything. That's why you look into, the tighter time frames. I'm going to get a 5-minute candle close, and I'll know where this signature is right off the bat, right? Way earlier than I do on an hourly or 2 hour. Okay. Good questions here today, guys. Trevor says, great, been doing this, thanks. By the way, learned tons from you about divergence, and it's been so useful. Trevor, cheers, mate. That's our goal. Sir, please don't forget today's range for metals, especially gold. I got you. Not leaving yet. We'll push this session a little bit longer today. Kiwi CAD, any questions? That was number 10. Going once, going twice, sold. I did promise to cover dollar CAD and euro and crude and the commodities. So dollar CAD levels haven't changed heading into tomorrow. Oh goodness, I almost forgot. How could I? Tomorrow is double whammy day, my friends, for CAD. Fridays, usually when we get these, it can be a phenomenal day for dollar CAD because you have the non-farm payroll report for the United States. Obviously, it's going to drive all the dollar pairs, but you also get the release of unemployment rate numbers from Canada at the same exact time, 8:30. We're expecting to see a hold at 7% on the unemployment rate and a loss of 15,000 jobs. This is after a surprise, massive run-up last month with that 43.9 thousand print on net change jobs for Canada, expecting to see a contraction 15,000. So look for this to really offer some volatility on the dollar CAD cross, specifically with the NFP release at the same time. And based on the performance of the figures, obviously, of the data, you could really see this thing shake things up. That being said, here's what dollar CAD looks like on the intraday. Okay, nothing's changed. 133.67, 133.75 is still the level of support to beat. Now, you're getting this thing sitting there trying to break through it all week. Divergence into that low there that we made yesterday kind of had me looking higher. The rally failed right at the initial resistance that we talked about at 134.53, and here we are round trip right back at the lows. Look, with the dollar being really tired here, I do think it can make a downside move. The broader picture, I kind of want to stay constructive, but immediately you're at support with the dollar under pressure. So as a disclaimer, I don't have anything on this. I did have a small long position on earlier. It got stopped out at break even. I didn't even get to peel off a quarter. It just got stopped out at break even. So I don't know what I'm going to do with this or if I'm even going to touch this today to start the month. But certainly know this level. If you break below 33.67, specifically on a closed basis, you're basically risking a drop towards 33.13. More importantly, this key region down here. The bullish or the bearish near-term bearish invalidation level is still going to be at the weekly open. We need to clear that 34, basically 35, 34.99 level to the upside. All right. Who asked about dollar CAD? Kelly, was that you? Questions on dollar CAD? He says, okay, got it. Right on. Right on. Yeah, I'm a little bit hesitant here, which is why I didn't have it on the list today. I've been liking the upside. If you saw the report, I put out a piece on this on Daily FX a couple of days ago. I updated it yesterday on SB, or on Wednesday on SB, but the point being 33.67, 33.75 is still the level for me. I really can't get excited on a short exposure while I'm above that region. And at the same time, any longs I've taken can't seem to make it through the weekly open. So, look for that move through 34.36, 34.50 first to be the sort of onset of the continuation higher, but you're at support to start the session, Kelly. All right. So that is number 11. Okay. Real quick, euro dollar, and then I'll jump into the metals for sure. Here's euro dollar heading into NFPs tomorrow. Really, really lackluster to start the move, guys, or to start the month and the week. It's a weekly opening range break. Look for the break. I really have nothing. I wouldn't touch this right now for me. If you're looking to range play it intraday, sure. But it's been real lackluster. Momentum has just been straddling 50 here on an intraday basis. If you look at this at the daily chart, the real basic problem I have is that you're coming up on a big support level. Obviously, the lows from December, obviously the lower median line parallel, and we've been in consolidation here. Momentum is back above overbought. I don't know. I like it higher. Inevitably, I do want to sell that rally, but right now I still like it higher. You're kind of sitting mid-range for the week. You're not near support. You're not near your resistance. So immediate move from here, guys. I don't necessarily have a setup. Again, gun to my head, I would say that this is going to move higher first before we start to turn over again. Do I have a trade setup per se from this level for new exposure? Not necessarily. Jamie really crushed it yesterday on this move, right? Catching the high and the low. Really well done to him. But from here, new exposure from this level at essentially you're sitting at the weekly open and mid-weekly range. I don't have any play for you just yet. All right, so who was that for, euro? I hope that makes sense. I think it was for you, Eileen? Okay, gotcha. Yeah, I mean, again, I like it higher. I just, what are you going to do? Take a long here with a stop at 55.50? It's 50 pips away. Not really my style. So that is euro number 12. Let's go into the commodities. for you, here's gold and silver Conwall. I also still do want to touch base on the Nikkei 225. I just think it's at a very interesting juncture here that we want to pay attention to, specifically as stocks continue to rip to new highs. You know, I think this is the Dow's coming off of 14 session gain out of 16. Pretty unprecedented stuff as we continue to rip into fresh highs here. But it looks like it still looks a little bit tired now recently, near term. You know, the S&P kind of stalled out yesterday a little bit. But long story short, let's jump right back. Gold. Here's what gold looks like. Breaking support today at the 618 retracement 1171. We talked about that last week. It's exactly where we based. We wanted to stay bearish sub 1203 into 1200. You've rallied and failed just ahead of that. The high was actually 1196, and here's the turnaround and break lower. The only thing I want to note is this. This is ugly divergence because they're both below 40, and it's not a very strong signal. But I do want to point out this parallel here. Oh, not that parallel. What I want to point out? Oh, that lower parallel there. Excuse me. So 1120 into 1130, a $10 range essentially. Let me just see what this looks like. Okay, I'm not going to stress it. But big region of resistance. This is your 2014 low. Okay, and guys, I'm going to just refer you real quick to the weekly charts that we've been following. You guys have seen this. This is on the radar chart, has been for the last 2 weeks on the intraday page. Here's what the gold trade looks like on the weekly basis. Okay, big region. Big region. So this is your 2014 low. Your 764 retracement of the entire advance off of last year's low, and an exact 1618 extension from the decline off of this year's high. Big region, okay? And that basically comes in 1120, 1130, $10 range. Stay bearish sub 1110. So the weekly chart and the intraday and the daily charts pretty clear and decisive as far as the directional bias. Remember, momentum is in oversold territory. That's not a reason to get bullish, okay? That just means that there's enough push on this to keep it going. If we cross back above 30 over the next couple of days, I'd start to look for a little bit more of a near-term recovery. As we stay down here, the risk remains for further losses. I have a soft target at 1142, but this is the bigger target here, Conwall. Key resistance near-term, 1202. All right, that is the gold trade. Silver. You know me, I'm not really too hot on silver right now, but the levels are also looking pretty good. Now, I don't know if I want to constitute this. You haven't really seen a break yet, but the low day close, we talked about this earlier in the week, 1627 is still the level I need to see kind of break to get the next leg lower. Let me clear this up. We don't need this anymore. Actually, this belongs right here now. Okay, this is what I'd be looking at near term. There's that support region we talked about earlier in the week. We're checking it. Whoop. We're checking it right now. So you need to break below that 1327 region. If you do see that, look for a move. Soft target here. This is just a pivot in price near your 1595. Okay. And more importantly, that 1618 extension from the decline off the highs. That takes you into 1570. I'd still put bearish invalidation at this week's, or what is that? I guess that's last week's high. Okay, watch this support though. If you're holding shorts into this region, you know, that's the level you need to beat to get this thing going. So plan your trade accordingly and place your stops accordingly as well. Here's what the intraday chart looks like for silver. Conwall, we were looking at this on Tuesday's webinar. It's the same pitchfork, man. It's actually still in play. And the high was actually the exact 618. We talked about that, right, on Tuesday. The pullback, this is where we were during the webinar. Remember this specifically, also the 618. And we came back yesterday, and look where we found support. This was an exact 100% extension. This is the reversal close, right? Hourly reversal close. This is a decent region. This is your exact sort of meaty range right now, 1651 to 1630. Okay, risk is lower. Risk is still lower, sub 1685. November ISM manufacturing out in 20 minutes. Will it have a big impact on the U.S. dollar? It's the biggest print for today, D. You know, barring a miss, I don't think it'll have that big an impact ahead of non-farm payrolls, but she's absolutely right. Here is, if I can type, here's what the ISM is expected to come in. Manufacturing is supposed to come in at 52.5 versus 51.9. That would be, 52.5 would be the highest that we've seen since July. So if that maxes a July print, which was the highest we had seen till 2015, June of 2015, if it maxes 52.6, yeah, I would expect that would give a relief to the dollar, or at least curb some of the dollar losses that we're seeing. I don't expect there'll be any major market move here on the data unless there's a big variable miss heading into non-farm payrolls. Because remember, guys, with everyone expecting the Fed to move, the risk is that bad data will stall them. So as long as the data doesn't fall apart, you know, everything should be pretty rosy for the markets. Now, if we get like a 48 print or something like that, remember with ISM above 50 means expansion, sub 50 means contraction. Certainly if we get a contraction or something like that, well, that puts pressure on the Fed to say, whoa, hold on, let's take a step back. Maybe it's not the right moment, right? So as long as everything is sort of in line with expectations or better, I don't expect that we'll see any major market moves on it. Okay, a real quick just gander at the 225. I really have to run, but just because it came into a resistance level today, and I think it's kind of been one of the leaders for the rally that we're seeing in equities. You know, basic median line resistance. Also, this completes an exact 100% extension from the rally off the lows that we made back in June, 2 equal legs up. It could be a near-term target here, especially since we're getting a reversal candle here today. So certainly the top side immediate bias is at risk. You can see that there's divergence in momentum as price action pushed into a newer high. The oscillator did not push into a newer high. Again, this is happening above 70, so I wouldn't put too much credence on it. That said, certainly the risk is for a near-term exhaustion trade here in the Nikkei. So keep your eye on that resistance target there. May be something that could trigger a little bit more of a near-term recovery or a near-term pullback in some of these really extended trades that we've seen over the last couple of days. All right, guys, I definitely have to run. Sorry about the prolonged session here today, but I wanted to make sure we covered everything ahead of non-farm payrolls tomorrow. I want to wish everyone best of luck trading into the close of the week, start of December trade. Keep it light. Again, non-farm payrolls, real light participation as we open up December trade. As we get into next week, we're going to have a lot of meaty setups in play. I can guarantee you that, specifically with these Aussie crosses and sterling crosses really starting to give us that directional move we've been looking for. Guys, have a awesome weekend, and I will see you all bright and early Monday morning. Remember, we have that free public webinar on Daily FX, and then Tuesday, Wednesday, and Thursday we'll be right back here on SB. Best of luck trading, guys. Cheers.